Welcome to Agency for Agents, a podcast for real estate team leaders and independent brokerage owners looking to maximize profits, effectiveness, and gain freedom for their team and business. Your hosts, Christine Andreasen and Aaron Hendon, have been running one of the most successful real estate teams in the Seattle area for more than 8 years. They know building a winning team means finding ways to empower, nurture, train, and develop individual agents to discover their own power, their own agency. On the podcast, Christine and Aaron interview thought leaders in real estate and personal growth to help you impact both your performance and your teams. We know it takes a lot, and leaders and brokers that crack that code reap the rewards of success greater than any they could ever achieve on their own.
There it is.
There you go.
Okay.
All right. Tell us what you do.
Hi, guys.
Hi.
Hi. I am the CEO and co-founder at SolidBlock, and we tokenize real estate. In a nutshell, tokenization is providing liquidity for real estate assets on the secondary market, which solves a big problem for many investors who are reluctant to put more money in assets or in projects that have their money stuck for 5 to 7 years, right? Instead of investing in something and expecting to get the money back in such a long period of time, you're able to invest and then trade your investments.
So you got to break all that down, because I definitely understand the words, but I'm trying to figure out how they apply in reality. So when you're talking about tokenization of a real estate transaction,
What's that mean?
that means, tell me where the tokenization comes in. I'm an investor. I see a multifamily property that I'm interested in investing in, 4 doors. It's 2.5 million, let's say.
Right.
Okay. I would normally go to my lender or take cash from another deal and put it in that building, hopefully as a positive ROI. And I hear what you're saying about, I can't now do anything with the bulk of that cash until I sell that property. Everything I have is in theoretical value that I can't access. Tell me where tokenization fits in and where it starts and how I connect those dots for me.
Absolutely. So number one, for you have an option to obviously go to a lender and bring a bulk of those funds, but you still have to bring in the equity, right? So normally when we talk about tokenizing, bringing investors in, we're talking about the equity part of your project, right? So let's say your property is $2.5 million. You got a loan for $2 million, you still have to come up with $500,000 in cash. So we're talking about bringing in LPs, limited partners or investors to put the money down together with you.
Sure.
We normally do it for a larger project, right? So maybe 10 million, 20 million, right? Okay. But let's just say for the sake of this example, right? So you have an option to bring investors to the project all the way in the beginning, right? Let's say that you have a good investor community, especially as a real estate agent, people who bought houses with you, people who bought apartments with you before. And now maybe they're not in the market for an apartment, but maybe they have some money saved on the side. What do they usually do with that money, right? So they have $50,000, $100,000 saved. Maybe they'll put that in the stock market. Maybe they'll buy Bitcoin, maybe they'll buy stocks and bonds of sorts. But they can also put that in a real estate project with you because they believe in this project. They believe in your ability to negotiate a good price. And, you know the market, right? You're operating in that market for a long, long time. So, and they like real estate. So they put that money, let's say they put 100,000, 4 people put 100,000 together with you. Now, in the normal circumstance, in the traditional market, they're dependent on you to sell the property to get their money back, right? If they come to you in a year and they say, Aaron, remember that 100,000? Right. Now I need to have a bar mitzvah for one of my kids. Like, can I have that back? Right. So where are you going to come up with 100,000? Right.
Someone's got to buy them out.
Someone's got to buy them out. So now you have the headache of going to your other clients and saying, can you buy them out? Now the price is uncertain because in that year, your property has gone up in price, right? Are you going to give that person now $110,000, right? So you don't know how much that increases, right?
Right. And I also don't know. The other thing is I don't know. I mean, they're getting out now, but they're not assuming the entire risk of the entire project because it could go down later. And then I paid them and I lose twice.
Exactly.
Okay.
So that's the first scenario, is that you bring your 4 friends or 4 clients, and they're not dependent on you to go out and resell it to someone else, or they're not dependent on you to sell this at some point, right?
Well, hang on, wait, you made a leap there because I was almost there with you. So this is really good because I could actually almost see this yet. That was 4. So we each put in 100,000, but we're first putting it into tokens. What?
No, the token is just basically, so in general, what is a token? Like tokens existed a long time before cryptocurrencies and blockchain. You know, in many countries, you had tokens to even go into the subway, right? We call that a token, or to use a phone. It's basically some sort of a replacement for our currency, right? Like they say token of appreciation, right? So it's just basically something you can use instead of the paper dollars, which are difficult to stick into a phone booth, right? In a phone. So that is the same with blockchain and the same with crypto. A token is just basically a representation of an asset. So when your friends put in $100,000 each, for convenience sake, we're going to give them 100,000 tokens each. Okay. Now, the nominal price of each token is $1, and then how many tokens they got is just based on the appraisal of the property, right? So they got, 1,000. The whole property is worth $2.5 million, right? We decided that we're getting a loan. We only need 500,000. So on the 3rd of March, 2022, when you went out and appraised this property, it was $2.5 million. So they bought the property at a $1 per token nominal price. Maybe on a 3rd of March, 2023, the property is going to be worth $3 million because you did some renovation or something like that, right? So now their token, instead of $1 per token, is now going to be worth $1.20, if I'm calculating this correctly, right? So that's basically how it works. So how are the tokens created, and why is blockchain a very powerful tool for ensuring that you and your friends are going to stay friends no matter what, right? So blockchain is an immutable ledger, which means it's basically an accounting system, which is much better than your average Excel, where you would put their, a PDF where you would put their ownership, right? Jack bought 100,000 shares from me for $1 each, right? Instead, what you have is you're going to have create a company just like you normally do in real estate to hold a piece of the asset. This company is going to hold either the whole thing, like the whole equity, right, payment, or it's going to, maybe you'll decide to raise a part of it, right? But basically, it's going to hold a piece of the asset. So that company will issue shares, actual shares, right? So let's say that it issued 500,000 shares and you all split it up equally, right? So each of you got, let's say, or not, we decided each of you got 100,000 shares, right? For that example. So then instead of using an Excel file or a database somewhere, we actually are going to take a blockchain ledger, which is based on some sort of a public blockchain like Ethereum, which is an example, which is the first and the most popular blockchain. We're going to create a smart contract, which is like a regular contract, but it's smart because you cannot erase it. It's there forever and for everyone to see. And you're going to see that 5 people, it's not going to have names, but 5 wallets, 5 people or 5 investors, whatever, each bought 100,000 shares in this asset. That's what it's going to say, right? They bought it in with cryptocurrency. Sometimes it will even say how much they paid. A lot of times, people don't pay with cryptocurrency, so we won't see how much they paid. And instead, you'll see that on the platform like SolidBlock. You'll see that somebody paid X amount of dollars to get X amount of shares. So a token is basically a digital representation of their share. Their shares are actual shares that the company holds, right? Whatever you issued in Delaware or in Wisconsin or in Florida, right? When you open the company. Now, a token is going to be almost like a title registry that sits on the blockchain and tells us who owns that company, right? Who owns, which are the 5 people that own, the 5 wallets that own these shares. And a token is just basically a digital representation of the actual shares in Delaware. That's all it is. And that's why we call it a token, because it's not a share, it's a digital. Some people actually call it a digital security, right? A token and security token and digital security is the same thing. Why do we need a token?
Good.
Because maybe one of these, in a year, Jack is going to come and say, I want to sell. In fact, instead of coming to somebody and say, I want to sell, Jack is just going to list his securities on an exchange, right? So obviously the owner of the project, Aaron, is going to make a deal with an exchange and say, I want to sell our shares here. Now I want to sell our securities here. There are going to be some fees involved. Great. So Jack wants to sell. He pushes the button on the SolidBlock platform. Tells us how much he wants to sell. Maybe he doesn't want to sell the whole thing. Maybe he just wants to sell 20,000 shares, right? Then the shares go on an exchange. There's a secondary offering. Somebody buys those shares. Jack is getting cash, right? So that's why we use a token, because a token is much easier to trade than the actual shares, right? So, and then remember, the shares actually represent the ownership in an asset because that company owns the asset.
Okay, so it's a way of. So I'm just looking at what the value add is. Without the blockchain, without the tokens, and without the blockchain, if Jack wanted to sell half his stake, he would need to personally go around and shop it to investors personally, and then get a lawyer involved to write up the contract to transfer the shares. And then he could transfer the shares. If he could get a price he wanted from his own shopping and get a lawyer to draft that, which would probably have to include the original contract to make sure that Jack had the right to do that. All that work, you're saying, all that work is now incorporated up front in the tokenization of the shares, that there's an agreement up front that there's an exchange, a specific exchange. So SolidBlock is an exchange or not an exchange? What does SolidBlock do?
We prefer not to be an exchange at this time. So because there are other members of the ecosystem that do this really well.
And who?
Yeah.
What's an example?
The good examples are T0 and INX, Texture Capital. Those are the 3 that we work with in the US.
And those are marketplaces. Those are
marketplaces for the secondary, where people are interested, investors are interested to buy shares from somebody who bought them before.
Gotcha.
And shares in all sorts of different projects.
Right, and all sorts of different projects.
And what I would do at the beginning of this project is the upfront cost of joining the exchange would be shared by the investors, because that's their exit. It's everyone's exit strategy. So you're paying upfront for exchanging you're getting a bigger marketplace for your shares potentially to sell them, and ease of selling them, and you're upfronting the legal expense of selling them. Is that correct?
Yeah, absolutely. Okay. So some of the costs are usually borne by the investors, exactly, because they want the liquidity, right? The costs are not that high, actually.
Okay, but that's what it is. It's liquidity, because you're hooking up with what you think is the most liquid, the easiest place for me to sell these if I wanted to get out. But other than that, there's no. I mean, if the project goes through its 5-year intended outcome and we flip that for $4 million later. We don't do anything with the exchange. We just get the money from the sale of the property and divide it up any way we want, and pull it off the exchange. The exchange never comes into it. Is that right?
So in general, you always have the ability to sell the underlying building.
Right.
In terms of regulation and just in general, every time you have an offering, you outline a business model and some sort of a philosophy, right? So when you bought that building from the get-go, you're going to tell your investors, right, Jack and everybody else, guys, my plan is to hold it for 7 years because I think that's when I get the best valuation for it. But if in year 3 it reaches a valuation of X, I will consider selling this, right? Or if in any year, right? So what happens is like if in year 4, all of a sudden the market is so hot, or maybe you expect to be a downturn in the market, then you'll tell your investors, guys, I want to sell the project. You sell the project and you distribute the share, basically the income pro rata for those investors.
And can I walk in? Anybody can, or go online anywhere to InXS or whatever you said was here in America, and say, and look at all the different offerings. It's available to the public to go look at the offerings and buy tokens.
It's a great question, Christine. So in order to do these offerings compliantly, we normally do what's called a Reg D 506C exemption. And that's an exemption that allows accredited investors to participate in offerings. That said, for smaller size investments, so up to $5 million, you can do crowdfunding. So if you put a tokenized project on a crowdfunding platform, then you'll be able to actually bring in anyone as long as they invest up to a certain amount. So it might be up to $10,000, right? So you would need to bring a lot of investors, as opposed to, 5 people who will do, who will invest 500,000, in total. There are other types of offerings, like there was a Reg D 506B, but there is an issue that one is limited to 35 investors. So you can use that initially, actually, to bring in some retail investors and then reclassify eventually.
And what's the difference between the crowdfunding and the market and the exchange?
Crowdfunding is just basically a marketing tool, right? So you bring in the retail investors. Crowdfunding is just...
But you can do that on the exchange, whatever exchange you pick. It's independent. It's not...
Yeah, crowdfunding is the first stage. It's just basically you go and you use it for regulatory purposes. This is a company, a crowdfunding portal is a company that has a FINRA license to market to retail level investors. Right. So that kind of helps you guys when you go and you sell your offering to do it compliantly. So SolidBlock, we actually will soon offer that capability on our platform as well. So you won't have to go on a separate crowdfunding portal. Right now, we have certain partnerships where we put the projects on their portal, and then after the raise is complete, it's tokenized, and then the investors who participated can resell. Right now, if you go on a crowdfunding portal anywhere, which, they're pretty popular, you get your shares, and then again, you don't have an exit strategy.
Good. And so SolidBlock is where in this process? Because now I get the idea of tokenization. So it's really, it's actually, tell me if I'm right. Tell me if I do understand this. So Bitcoin, Ethereum, Dogecoin, whatever, all the cryptocurrencies operate on a blockchain, but they're independent. They're all independent. It's like investing in in whatever else, gold, silver, corn, whatever you think is going to, those independent things. But the science of blockchain is independent of that. And you're really building something on the science of the technology of blockchain, independent of crypto. You're not really selling a coin. You're using the technology of blockchain to make investing easier.
That is correct. Okay. If investors do have these other coins, which is basically a form of currency, they can actually invest those coins in real estate projects, just like they do dollars and everything else.
Right. I mean, for whatever it happens to be trading for that day.
Yeah, exactly. They can come on our platform and just buy whatever asset they like, just like they buy it with dollars. So that's the only connection with crypto that we have.
Right. I get it. And then so you are the platform that you're the intermediary, someone that can actually get that established, because I would have no way of tokenizing without a partner to actually do that.
So we're the tech partner that has the capability to enable you to write these transactions on the blockchain, right? Because right now you have the capability to only write these transactions to an Excel file or maybe some, SQL database on your website on WordPress, right? So we put that on steroids for you and make that immutable. Also, Jack will only come to you right now because he trusts you, because he's your friend. But imagine if you brought in investors who you don't know. The blockchain enables them to come and see their transactions on the public blockchain, right? So that they know that their ownership is safe.
And all the terms and all the contract itself is on the blockchain.
Exactly. I want to go through a second use case, Aaron, from what you described.
I'm just really excited that I have some understanding now of what this. I don't think I can tell anyone else what it is.
I know.
Oh my God, I could totally get how that's actually useful, because I've always thought blockchain is brilliant. I don't need to invest in gold or, Bitcoin I don't know that there's a life inside that, but blockchain itself is brilliant for this reason. Now I understand why. Go ahead. What's the second?
I mean, crypto is pretty cool too, just in general. It's for diversification purposes, right?
Sure. I mean, like if you think gold is pretty cool, then crypto would be pretty cool. Yeah. I mean, look, it's all for diversification. It's just
diversify. Exactly. Even within real estate, I would say diversify, right? You can invest in some illiquid assets that, and then you can invest in some liquid assets, right? So this is just a different class, right, of real estate. So the second use case would be if you just front that $500,000 all by yourself, and then you go and you develop this property a little bit. Maybe you renovate, you bring a new tenant, or all the new tenants you populate, right? And now your asset is actually worth much more. Let's say maybe it's worth double, right? Now it's worth $5 million. So now what you could do is you could go out and sell it to another buyer, but maybe you expect more appreciation, or maybe you really like the asset and it's high yielding. So you actually want to keep it. But, why would you keep a full asset, which actually is worth $5 million? You should enjoy some of that money to start building a new one. So you're going to bring 4 friends who are going to now put in the money, not because they're expecting a huge increase, but because they like yielding. These are different friends, right? These are friends that they like yielding real estate, which is stable, right? So maybe you're going to give them 7% or 8% annual return. Right. So you're going to tell your friends, come in as LPs, as my limited partners. Each of you will buy into, $500,000, right? And they're going to buy 2 million out of the 5 from you. So that's your exit strategy right there. So instead of selling the whole thing, you're going to sell it fractionally to people who want to hold an asset that is yielding and stable.
And all that. So I got this asset. Now I take the asset and I bring it to you after I put the work in. And so it's gone from 2 million to 5 million. And I say, okay, now I'm ready to fractionally sell this. And I'm writing those new terms onto the blockchain of what their return is likely to be, or whatever I want, whatever terms I want.
Exactly. And the only difference here is that it's just different types of investors. The initial investor is somebody who it gets a bigger payout for bigger risk, right?
And that's the second use case is I could take that what is now assessed at 5 million, bring it to the blockchain and see who wants to do it. I'm putting it in the marketplace. I don't need the 4 friends anymore. I'm going to make 8 new friends or whatever.
That's the idea. As the market develops, you're going to have more and more demand for this, right? So, but the demand will also depend on how much of a track record you have, because it's just a product, right? It's a product. It's just like any sort of a real product on the market, right? So they'll look at the asset, but they also look at the asset manager. Essentially, either you're the asset manager or you have the asset manager for hire. Yeah,
no, I get it. It's great. And then it's about how you market that. And the exchanges are the equivalent to, or the idea same between the NASDAQ or the Amex. I mean, it's just an exchange. It's nothing.
So NASDAQ is actually starting to offer this as well. They're putting a lot of information out there. But right now we're talking about smaller exchanges.
But it's the same idea. There's no difference between the two of them other than the actual assets that are on them.
Right. There's some difference because NASDAQ mainly caters to, the main area of NASDAQ is for retail investors. Now, ATSs are alternative trading systems. They mainly cater to accredited investors, unless you did what's called a Reg A+, which is a different exemption. And that's actually a great option, by the way, for retail. If somebody has a big community of retail investors, like really big, right? So, and then a lot of real estate agents and realtors have that. So we can do what's called the Reg A+ offering, and then they can actually bring in up to $75 million in one offering from when I say retail, what I mean is not accredited, right? Accredited investors are investors who earn a certain level of income or have certain level of assets. I believe it's $250,000 per person or $300,000 per family, plus $1 million or $1 million in assets beyond their mortgaged asset or, one asset where they live. So that's basically the definition of an accredited investor. And that's done because now you guys are not selling real estate anymore. You're selling securities now. So, and actually, just one important note, more from an advanced advanced class, because you are the owner of this project, you're no longer the agent on this project. You are actually the owner, right? You're the sponsor. You're able, in most cases, to distribute it to your friends or existing network without a broker dealer, without being a broker dealer, right? You would not be able to do that as an agent because you need to have actually a broker dealer license to distribute securities. Anything you're breaking down in parts generally is considered a security. If you're selling an apartment, if you're selling a house, that's great. If you're selling one property to several individuals, but you're writing all of them in a title or you're writing all of them as owners of the company, then you might get away without calling it a security. But with digital things, it's always going to be a security that you're selling.
Wow.
Killer.
Interesting.
All right.
We're over time too. Fascinating.
Yael, that is so, I just so appreciate, taking the time to really educate me on this. Something I've really been interested in, but don't know who to ask or don't know where to go. And it's one of those, I'm supposed to understand it kind of models. So I really do appreciate it. Thank you so much. Anything else that we forgot to ask?
No, I think you guys are right in the money. And just one thing I want to reiterate for the audience of realtors, real estate agents, anybody who's dealing with large audiences, this product is for you guys. But this product is for you to basically level up, right? To take your audience and become a sponsor. So you can now actually be a sponsor and bring projects because you are the experts in real estate. Nobody knows it better than you guys. So now this is the technology that can help you become sponsors and earn much more money from carried interest, from the value increase in the property, right? And it's just a matter of enabling your audience to become investors in liquid property that they can go in and out, right? They can basically play with real estate like without having to wait for years, right?
Yeah.
That's the premise.
Very cool. All right. Well, I feel like we've just scratched the surface of it.
I was thinking we need to do another for the advanced, although we're not quite advanced. I don't think I've ever said so little. I'm just sitting there going, what?
Right?
It's fascinating.
So fascinating. All right. Well, Yael, thank you so much for the time. Go enjoy your new cat.
Kitty cat.
Thank you. Have a great day.
Have a great day.
Thank you for tuning in to another episode of the Abundant Life Podcast, brought to you by Christine & Company and eXp Realty, the global online brokerage powered by top agents and cutting-edge technology. If you liked what you heard, consider subscribing wherever you listen to podcasts. Your hosts have been award-winning brokers Christine Andreasen and Aaron Hendon. For more on them, visit christineandcompany.com.